Okay, so welcome to today's session. Uh, let's start with a quick recap of what we have been covering or what we actually covered in the earlier sessions. So we did talk about the difference between internal and external auditors. So we did talk about the internal and external auditors. So we did give a distinction between internal and external auditors. Besides that, we also did look at the difference between a limited and a reasonable assurance. So we did talk about the limited and reasonable assurance. So we did talk about the auditor being hired to either give us a limited or a reasonable assurance. So the auditor can give us a limited or a reasonable assurance. Remember, if it's a limited assurance, it's just a review. They are not carrying out a detailed assessment of the financial statements. Then also we did talk about the elements of an assurance engagement. So please make sure these areas, if you've forgotten, do go and refer back to what we did. So we have elements of an assurance engagement. And also, besides the elements of an assurance engagement, we did talk about what the principles that are supposed to be governing someone as an auditor is supposed to be governed by principles. So there are principles that are supposed to govern you as an auditor for you to be able to conduct your assessments. So there are principles governing auditing. Then besides the principles governing auditors, we also did talk about what you need to consider before accepting a new engagement, accepting a new audit engagement. So you've been hired to conduct an audit. There are issues that you need to first of all consider before you accept the new audit engagement. Then besides the issues to consider before accepting a new audit engagement, we also talked about the audit engagement letter. We did talk about the audit engagement letter. So there is need to draft an audit engagement letter. So there is need for an audit engagement letter. So the audit engagement letter, this is the contract which clarifies the terms and conditions of the engagement. So there is the audit engagement letter. We also did talk about, besides the audit engagement letter, we also did talk about the ethical principles that are supposed to be governing auditors. Ethical principles that govern auditors. So you can say ethics and threats to the auditor's independence. So we looked at ethics and situations that can threaten the auditor from being independent. Because as an auditor, you have a lot of people that are relying on your word. So you are supposed to make sure your views are not influenced. Whatever you tell us is not influenced. You are supposed to give an opinion that is independent, that is not influenced by personal gains, that is not influenced by familiarity, that is not influenced by advocacy threat. So we did look at situations that can cause advocacy threat, that can cause a threat to the auditor's independence. So today, let's start with audit documentation. So let's start with audit documentation. So as auditors, we are supposed to document our work. So as auditors, we are supposed to be documenting our work. So if we are documenting our work, what is audit documentation? So the audit documentation process involves keeping records. As we conduct the audit, we are supposed to be keeping records. So audit documentation. So what does this look at? This looks at the recording. So as auditors, we are going to be recording the procedures. Just a moment, okay. So this looks at recording the procedures taken by the auditors. And the evidence that the auditors obtained. So if we are documenting, we can document the steps that the auditors have taken. We can document as well the evidence that the auditors have gathered. So before the auditors can come to a conclusion, they have to first of all gather evidence from various sources. They have to first of all confirm the information that they have. So documentation now is when they are keeping record of the information that they have obtained. So they are keeping a record of the information that they have obtained. So the records are called the auditor's working papers. So we can use the term audit, the working papers of the auditors. So the evidence is documented in the audit working papers or in the auditor's working papers. The evidence is documented in the auditor's working papers. So that evidence we have been gathering, or even sometimes not the evidence, but the procedures, they are documented. So if there has been documentation, it can help us. Let's actually look at the purposes why we document. We document the evidence, we document the steps, so we can say the purposes of audit documentation. So the purposes of documentation. So the purposes of documentation. So once we are conducting the audit, we are going to be documenting the evidence that we are collecting. So we document the evidence so that we can use it to come up with our conclusion. So the evidence that we have documented, it becomes the basis for our opinion. For us to say the accounts are true and fair, the accounts are misstated, is based on the evidence that we have documented. So the documented evidence is the basis for the auditor's opinion. So the documented evidence is the basis for the auditor's opinion. So this is the basis for the auditor's opinion. So for you to come up with your conclusion as an auditor, we want to see the evidence. What have you done to say the accounts are true and fair? What did you do? So what did you do for you to say these accounts are true and fair? Then also, besides documentation assisting in terms of being the basis for us to say the accounts are true and fair or not. So documentation as well, it can actually help if we are to go with juniors to conduct the audit. So if in the event that the juniors forget some of the steps that they're supposed to take, they can refer back to our documents. So the documentation, we can say that it can help the audit engagement team. To stick to their plan. So they can be referring back to the plan. They can be referring back to the documented steps that we are supposed to follow. So it can help the audit engagement team to stick to their plan because they will be having something that they have written down. So once we have written something down, it can help us to ensure that we are following the right step. So also writing things down, it could be writing the steps that we want to follow. It facilitates supervision. So it enables supervision. It enables supervision and review of audit work. If they are documented steps that you're supposed to be following, so the supervisor can simply be just watching to see whether things are being done the proper way, or if you have been documenting your work, we can be able to check whether you have done your work well, because you can just go through what you have been documenting and see if you were doing things the right way. So documenting in auditing, it can be used for supervisory purposes. It can also be used to check whether the audit has been done properly. So it can be used to review the audit work to ensure that it has been done in the proper way. So documentation also enables the team to be accountable, enables the engagement team, because the documentation is evidence that they are the ones that did it. They are the ones that, these are the steps that they took. So it enables the engagement team, that team that was carrying out the audit, to be accountable. Because if it has been documented, they can be accountable for their work. So once it has been documented, we can be made accountable because the documentation is showing us the evidence that it is you that did it. So we can be made accountable. So these are some of the reasons why we need to document. We'll be writing things down. We'll be keeping our documents as we conduct the audit. So let's now move on. So the auditors are supposed to be documenting their work, and they are going to be keeping the working papers. So the working papers can actually be used as well by other auditors that are to come. So I think that one we can also add it, that is our point. So once we have documented, it means if there are new auditors next year, the new auditors can use those working papers also for planning purposes. So this can assist in the coming year audit or in the next audit. So we'll be knowing which areas were the risk areas this year. So when we are now conducting the next year audit, at least we'll be having a basis on where to start from. So it assists in the carrying out of the next year audit. Okay, so those are some of the purposes why we need to document the audit process. Then as we document the audit, we can document the audit using different forms. So whatever we are documenting, we can say ways of documenting. It could be the evidence that we are gathering. So if we are gathering the evidence, we can document this evidence using, so we can say ways of documentation, of documenting the evidence. So as we are documenting the evidence, we can use the narrative notes. These are short notes. So the narrative notes, these are short notes which are used to describe what we have been doing or what we have found in the system of the client. So they are narrative notes. So the narrative notes are short notes that are going to be used to summarize if they are controls of the organizations, these are short notes summarizing the controls or summarizing the evidence that we got from the client. So they will be brief, but summarizing the key issues that we found in the client. So we can also present the information using graphs. The information can be represented using graphs, or the information can be documented in the form of questionnaires. So when we are asking information to get, when you're asking to get evidence, we might use questionnaires. So another way to document the evidence that we have obtained, it can be through the questionnaires. So we just keep the questionnaires where we've been asking. It could be the employees, it could be the questionnaires where we're asking maybe the customers or the suppliers. So also we have, we can make use of the checklists. So we can also make use of the checklist. So checklist, this is where, especially if you have areas where you want to make sure you have checked all the areas, like on inventory, you want to make sure that all the areas have been counted. You can use a checklist. You'll be ticking on the checklist on the areas that have been investigated. So let's move on. So these are some of the ways we can use when we are documenting the system. Now let's introduce from audit documentation. Let's move to audit planning. So before we start the audit, we need to start by planning. Before we start auditing, we need to start by planning. So we don't just start auditing. What starts is planning on how to carry out the audit. So we need to come up with an audit plan, how we intend to carry out the audit. So in the audit plan, it should show us the direction, it should show us the scope, and it should show us the strategy that we are going to be using. So in audit planning, we can say the audit plan is there to show us the audit plan shows the direction and scope of the audit. So in the audit plan, it can show us the direction of the audit. So after we've audited this area, which area is the next area to audit? We can find that in the audit plan. So we need to plan for the audit. We need to plan for the audit before we start auditing. Should we say? MA. Okay, MA just. Okay, let's move on. Benefits of adequate planning. So if we decide to plan, why should we plan? Let's look at the benefits of planning. So before we conduct the audit, we first of all need to plan. So why is it important to plan? So before we start conducting the audit, why is it important to plan? So planning can help us devote time and attention to important areas. So it can help us to determine which areas should we give more time. When you're now auditing, we know which areas are likely to have more risk. So before you go and start auditing a company, first of all, need to know your strategy. How are you going to audit? So we need a plan that is going to show you which area you're going to audit first. We don't just start thinking tag client, but we need to plan ahead and know how we are going to audit. So the plan helps us to determine, or we can say to devote appropriate attention to important areas. To devote appropriate attention to important areas. So the plan can help us devote appropriate attention to important areas. What do we mean by devoting appropriate attention to important areas? So the plan can tell you this area requires a lot of time. This area requires you to be more, to use maybe seniors. So you devote appropriate attention regarding the time and resources to areas that are risky. So it can tell you that this area there are likely to be more errors and misstatements. So you can't use juniors for this particular area. So if you have planned, it can tell you the type of manpower that is needed to conduct the audit. So you plan so that you know the areas that need more attention. You can plan so that you identify potential problems in time, so that you identify potential problems. And decide on the appropriate safeguards. So you plan so that you decide in time what is the best, what are the potential problems you might face as you're auditing this client. What challenges are you likely to face? Because companies can differ. The fact that you audited company A doesn't mean you are also likely going to audit company B with the same methods and same approaches. So we might have problems that we are now going to face for this new company. So you can be able to identify these problems in time and you then decide on ways that we are going to use to deal with these potential problems. So planning can help us to be prepared for the problems that you're likely to face. So we identify potential problems in time and we decide on the ways to manage these problems. Then also, we also plan so that we can be able to assign the right staff, assign the right staff or right employees to the audit, and be able to supervise their work. So we plan so that it helps us to allocate tasks. So we know who is going to carry out what. So we know the responsibility that each employee is expected of taking. So we plan so that we allocate the tasks to the employees that we have. So we plan as well so that we have direction, so that planning, it gives us direction. So planning gives the firm direction as to what they, let's just say it gives the firm direction. So if we plan, it can help us in terms of which steps are we going to take. From this step, what is the next step? It comes from planning. So planning can help us determine the next direction that we are going to take. So after auditing this area, what is the next area? It is through planning that we can be able to do that. So remember, when we are planning, whatever plan that we make, we document. So planning and documentation is something in common. You come up with a plan, then after you've decided this plan, you then document that plan. So you plan, then you document that plan. So the planning process, there is what we call the planning cycle. So it's not a once-off thing. So the planning cycle, let's have the planning cycle. During the audit period, the planning process takes, it can be done at different levels. So the planning cycle, we can look at the start of the year. So the year starts and you have been engaged to be the auditor for the next year. So if you have been engaged to be the auditor for the next year, you start planning for the next year audit. So you can call this on the planning cycle. So for the planning cycle, it starts with you planning for the next year. Or we can say planning for the year. Let's just say for the year, not next year, for the year that is come. So if you're planning, starts with you planning for the year before the audit. So you've been engaged, you've been told you're going to be our auditor for the year. You are planning for the year before the audit. Then you identify if there are any changes that are likely to, or any accounting issues. You identify any accounting issues that are of concern when you're now conducting the audit. So before you start conducting the audit, you start planning for the audit. Then there is the interim phase. You also plan during the audit. So planning during the interim phase of the audit. You are planning during the audit phase. when the audit is actually taking place. Then you plan at the end of the year. So the planning can be done before the audit, during the audit, or at the end of the audit. So we can plan during the before the audit, during the audit, and at the end. So anything that is done during the audit period, that is the interim phase of the audit. So the interim phase we are looking at during the audit. Then let's move on. When we are planning for the audit, we need to identify what you call audit risk. This is a very crucial area that is going to be examined in your area and in your exam. So we are going to, this one, there are high chances, in fact, in almost all exams, you will find audit risk. So as you are planning, you need to identify audit risk. So the auditor has to identify audit risk. What is audit risk? So if the auditor is identifying audit risk, what is audit risk? Audit risk is said to be the risk that the auditor gives a wrong opinion, or the risk that the auditor gives an inappropriate opinion. So we say the audit risk, it is the risk that the auditor gives an inappropriate opinion when the financial statements are materially misstated. So audit risk, it is the risk that the auditor gives an inappropriate opinion when the financial statements are misstated. So during the planning phase, we need to make sure we lower down audit risk. The aim is to make sure we lower down the audit risk. If zvikanzi pane audit risk, risk yekuti the auditor is likely to say things are correct whilst they are not. So there's a risk that the auditor ends up saying a wrong opinion. So if you don't plan well, you are likely going to give a wrong opinion as an auditor. So you are supposed to reduce audit risk. You are supposed to make sure you don't give a wrong opinion. What gives rise to audit risk? What can cause an auditor to give a wrong opinion? So there are components of audit risk. So the auditor can say a wrong opinion as a result of what? So the components of audit risk, number one, we have what you call the detection risk. So the auditor can say a wrong opinion as a result of detection risk. The auditor can say a wrong opinion as a result of inherent risk. The auditor can say a wrong opinion as a result of control risk. So detection risk, if the auditor is saying a wrong opinion as a result of detection risk, it means the auditor did not plan well. They used wrong procedures. So this is the risk that the auditor says a wrong opinion as a result of the methods that they use to gather evidence. Remember, auditor is supposed to gather evidence. After they've gathered the evidence, then they can give a conclusion. So which methods did they use to gather the evidence? If they use the wrong methods, they are likely to be affected by detection risk. So this is all down to the auditor. This is all down to the auditor. So detection risk is caused by the auditor. It arises if the auditor's procedures and methods fail to identify the risk of material mistake. So the methods used by the auditor, they failed to detect where there are errors and mistakes. So the auditor came up with his procedures to conduct the audit, but they were not effective. For example, where the auditor was supposed to ask where the auditor was supposed to ask the bank, they decided to ask the directors of the company. So they used a wrong procedure. Instead of inquiring from third parties, from those outside the business, they asked those within the business. So the procedure that the auditor used was not good in terms of identifying the errors and mistakes. So if the organization is a high-risky organization, the auditor must make sure they design procedures which reduce detection risk. So in a high-risk environment, the auditor's procedures must be designed to lower down, must be designed to lower down the risk. The auditor should use more procedures. An example of a condition that causes detection risk is auditing a new client. If we are auditing a new client, we are not familiar with the transactions of the client. So the auditor has to use more procedures. It's unlike where we are auditing a client that we are used to auditing. So auditing a new client is a high-risk client. Because we are not familiar, there is a high risk that the procedures the auditors are going to use won't be appropriate. So e.g., auditing a new client has high detection risk. Because the auditor will not be familiar with the transactions of the client. Will not be familiar with the transactions of the client. That's detection risk. Then, besides the detection risk, we have the inherent risk. This is as a result of the nature of the entity's transactions. So certain businesses, they have a high risk of fraud. Like in a bank, there is a high risk of money laundering than maybe in a bank, there is a high risk of money laundering than maybe in a grocery shop. So the nature of an industry, it is vulnerable to a certain type of a risk. So if the auditor fails to give the wrong opinion because of the nature of the entity's transactions or the vulnerability of the entity's transactions to a certain type of risk, then that is inherent risk. So inherent risk is saying the auditor failed to give the right, the auditor failed to give the right opinion because of the nature of the transactions, because of the standards that were supposed to be applied. So this arises due to the susceptibility or vulnerability of the entity's transactions to the risks of the industry. So a certain industry, the transactions of the entity can be vulnerable to certain types of risks. So these ones, they are associated with the nature of the entity's transactions, not because of the auditor's procedure. So we are saying the auditor gave a wrong opinion because they did not verify thoroughly the inherent risk. They did not minimize inherent risk. So inherent risk may also be associated with the accounting standards. This may be associated with the accounting standards that are associated with the entity's transactions. The accounting standards that are associated with the entity's transactions. So the auditor may fail to verify whether certain accounting standards were applied correctly that affect the entity. And if they do not check whether certain standards have been accounted for correctly, they can end up giving a wrong opinion. Then we have the control risk. This is associated with the systems that the client is using to record transactions. So auditor can give a wrong opinion because they failed to use the right, they failed to reduce detection risk. They used the wrong procedures, or because of the nature of transactions associated with the client's business. They've been using this, it could be they've been using this strategy for some time, but they failed this time around because of the nature of the entity's transactions. So this is a new client. We try to use the same strategies we have been using, but they fail to work because there is a risk associated with the nature of the business that the client is doing. Then the control risk, this one is associated with the systems used by the client. So the client has their systems that as an auditor, I come to your firm to audit. You are going to tell me in this company, we have a guard, we have cameras, we use Excel, we have a system that we are using for recording transactions. Then if that system is not working effectively, maybe the guard, at some point, the guard will not be there. At some point, the cameras will be off. Then as an auditor, I'm told that there is a guard who is operating 24 hours. Then I don't check everything in detail because I believe, I just think, okay, if there's a guard who is checking 24 hours, most probably nothing was stolen. Without knowing that this guard sometimes won't be around. So as an auditor, if I believe the controls that I have been told, and I fail to verify for myself, then I might suffer the control risk. So this is the risk that the auditor believed the entity's control systems that were not working well. So the risk that the entity's control systems failed to detect errors and misstatement, material errors and misstatement. The client's control systems failed to detect material errors and misstatements. So if there is a control risk, there's a risk that the client's system is failing to pick where there are errors, and the auditor believed the client's system which had errors. So the bottom line is, if there is audit risk, the auditor is going to give a wrong opinion. And what could cause an auditor to give a wrong opinion? An auditor can give a wrong opinion because they've not used the right procedures. That is the detection risk. They can give a wrong opinion because the industry that they are auditing, there are high risks in that industry, inherent risks. It could be because they believed a system that was not working well. Control risk. So when the questions are now coming, they will give you a case and they will say, identify. They'll give you a case like this. They will say, identify the audit risk and come up with the auditor's responses. So you'll be required to come up with the audit risk and the auditor's responses. So if the question says find audit risk, if you're given a case and they say find audit risk, So if we are finding audit risk, we are looking at the situation we have been given and trying to figure out from the situation given, what could, if the auditor is not careful, which situation could result in the auditor giving a wrong opinion. So if you are finding audit risk, in simple terms, you are finding a situation given in the case that is indicating that if the auditor so we are saying finding audit risk. If you are finding audit risk, you are finding a situation given in the case that is indicating that if the auditor is not careful, they might give a wrong opinion. So you're finding a situation given in the case that is indicating that if the auditor is not careful, they will give a wrong opinion. So there's a situation in the case that if the auditor is not careful about, they will give a wrong opinion. Then, when you are now telling us the auditor's responses, you are telling us how should the auditor gather evidence? How should the auditor gather evidence so that the situation indicated, or so that they can have more information? So that they can have more information regarding the issue identified. So that they can have more information regarding the issue identified. So regarding the auditor's responses, we'll talk about them later. For now, we want to talk about audit risk, identifying a situation that is given in the case. They'll give us a case. So identifying a situation in the case that if the auditor is not serious about, if the auditor does not check properly, this situation can result in the auditor giving a wrong opinion. Okay, let's move on. So audit risk. So identifying, the question will say identifying audit risk. Identify audit risk. If we are identifying audit risk, there are 3 areas that we are supposed to bring. So if you're identifying audit risk, you're supposed to talk about 3 key issues, if not 4. So the first issue is a risk indicator. If the question says identify audit risk, you start with a risk indicator. This is a situation you have been given in the case. Okay, let's first of all list them. We have a risk indicator. We have accounting treatment. And impact in the financial statements. So the question will say, identify a risk. I'll give you an example. So the risk indicator, it is the situation given in the case that shows or situation given in the case showing that there is a possibility of error or fraud. So they'll give you a situation in the case that can show you that an error or fraud might have taken place. So you identify the situation in the question that is showing that error or fraud might have taken place. After you've identified the risk indicator, the next step is to tell us the accounting treatment. What is the accounting treatment? The accounting treatment is how should this be treated provided that there are no errors. So this tells us how we properly account. I'll give you an example. How we properly account for the transaction, provided that no errors or fraud has occurred. So if no errors or fraud have occurred, how do we properly account for the transactions? That's the accounting treatment. How do we properly account? Provided that no errors or fraud have occurred, how do we properly account? So this involves quoting, or this involves determining the accounting standard in concern. Determine the accounting standard in concern. So you determine the accounting standard in concern. Then lastly, you need to tell us the impact in the financial statement. So this indicates what would happen if the accounting treatment above was not followed. What would happen if the accounting treatment above was not followed? Let's have an example. So you will be given a case. I will just come up with a very small case. So for our case, in the questions though, it will be a very long case where you just pick the risk. There will be more than one risk that they can say identify 8 audit risks. So Mr. K, or we can say KD Limited, KD Limited acquired, or we can say KD Limited entered into a lease agreement to use the property belonging to ABC Limited for 10 years. Belonging to ABC Limited for 10 years. This was recorded in KD Limited statement of financial position. This was recorded in KD Limited statement of financial position. This was recorded in KD Limited statement of financial position as a non-current asset. As a non-current asset. The other corresponding entry was the depreciation charge in the income statement. So they've given you this, and from there it will be part of the case. They say identify audit risk. If you are identifying audit risk, you are identifying something that if the auditor is not careful about, they are likely to give a wrong opinion. So identifying these risks, there's also need to, that's why sometimes encourage is better to do F7 and F8 or F7 first. Why? Because you first of all need to know the right treatment. You can't identify where there could be errors when you don't know the right treatment. So the first thing is to know what is the right accounting treatment. Then from that, you can be able to tell where there might be errors. Okay, so let's apply this to our template above. So we said, so the question says, identify audit risk. So we're saying from the statement above, what could be wrong? Cheptanga, you pick the indicator. What can indicate that there is a problem there? So my indicator would be, if it was me, my indicator would be KD Limited, or let me just, let me put here indicator. In the exam, of course, you don't write indicator. You just know it in your head. That's your indicator. So indicator is given in the question. You don't, you are not creating your own indicator. The indicator is the situation given that is showing that there's a potential error, there's a potential misstatement. So the indicator is something given in the case. So in this case, our indicator would say KD Limited. KD Limited entered into a lease, a 10-year lease agreement. To use the property of ABC Limited. That's a risk indicator. I've just picked this from the case. But giving a risk indicator, it doesn't make sense. You have not, because you simply copied what you're given. So you can't just leave a risk indicator and say, I've identified a risk. So identifying a risk, it means we need a risk indicator. If there is an accounting treatment, detection risk might not have accounting treatment. So if the risk is an accounting treatment, you highlight the accounting. Like in this case, so you highlight the accounting treatment that relates to the risk that you are thinking about. What risk am I thinking about here? The risk that I'm thinking about is, they said that the asset was on lease and they recorded it as a non-current asset, which is okay. And they recorded expenses, which is okay. But I did not hear them recording this in the non-current liabilities. So the lease liability, if we enter into a lease, the lease liability must be split between the current and non-current. And I didn't hear that they did that. So, and if they did not mention it, it also doesn't mean that they did not do it. But a risk, we are saying there's a possibility that they did not. So what do I do then? I highlight the accounting treatment relating to the area that I think was misstated. So according to every 60, according to IFRS 16, the lease liability must be split into current and non-current liabilities. Current and non-current liabilities, and recorded the statement of financial position. I can also talk about the other risk could be maybe they did not account for the finance cost. They just accounted for the depreciation, but at least there might be finance costs that we must account for. So let me stick to my first view here. So according to IFRS 16, the lease liability must be split into current and non-current. So in this case, there was a lease, and we are being told the lease was recorded as it was recorded in the statement of financial position, but I did not hear that they recorded the lease liability. That's why my accounting treatment was focusing on the aspect of the lease liability, because this is the area where I think could have been misstated. Then what next should I then do? I then move on to the accounting effect. So the accounting effect, I'm saying, if the accounting treatment was not done, if they did not record as I assume, what could be the problem? So where could it have affected if they have not recorded as per my assumption? So if they have not recorded as per my assumption, this would mean that the liabilities will be understated. It means that the liabilities will be understated because we have not recorded that under our liabilities. So if then you say there is a risk that the lease liability was not recorded, resulting in understated liabilities, current and non-current liability. So the impact is our liabilities are going to be understated. The impact is understatement. This resulted in us recording less liabilities, understatement of the liabilities. So these are, I've broken down the answer into different parts. But if you were answering this, you don't indicate this, you don't write indicator, accounting treatment. How then do we write it? Let me just now copy down these parts and put it as put it in continuous form. So your answer should be we take this part. So that's how the answer is supposed to be. We have included our indicator, we have included our accounting treatment, and we have included, so we've included our indicator, we've included our accounting treatment, and we have included our impact in the financial statement. So please take note. So the challenge here is that you must have an understanding of accounting standards. Because if you can see, I've picked this up and said this is in accordance to IFRS 16. So at least you must have a basic understanding of the accounting standards. So let's have a summary of some of the key standards that you might need to know of. So IS2, inventory valuation. So IS2 is a standard which tells us how inventory should be valued. So the standard says that inventory should be valued at the lower of cost and net realizable value. Inventory should be valued. If we have inventory, we should value it at the lower of cost and net realizable value. Inventory should be valued at the lower of cost and net realizable value. So if we have inventory in the business, we should value the inventory at the lower of cost and net realizable value. So this should be valued at the lower of cost. Inventory should be valued at the lower of cost and net realizable value. So if you are valuing inventory, if we are valuing inventory, we need to, first of all, consider which one is the lower of the two, the cost and net realizable value. What is the key risk if we are dealing with IAS2? The risk that is common is where inventory is valued at a price which is higher than what it's supposed to be. So the risk is inventory key risk. The key risk to watch out for is inventory having been valued. There is a risk that this standard was not applied and inventory have been valued at a price which is not the lower of cost and net realizable value. So there's a risk that inventory has been valued at a price which is not the lower of cost and net realizable value. And if this happens, it results normally in inventory being overstated, resulting in inventory, and inventory goes with profit, in inventory and profit being overstated. If we overvalue inventory, we overvalue profit. So if we don't use this principle, the risk is we are going to value inventory at a higher price, resulting in overstated balance for profit. Then another standard is IAS 7. So I'll just touch on some of the areas, but not in detail. So in detail, you do that for F7. So IAS 7, this is the standard on cash flow statements. So the standard on cash flow statements The cash flow statement recognizes three headings. Our cash flow must be reported under three headings. That is investments, operations, and financing activities. So the cash flows are reported in the three headings, which are operations, investments, and financing activities. What could be a risk here? A risk could be a classification issue where we have included, maybe we have included profit from sale in investments. So we have recorded in the wrong class. So the risk could involve misclassification of these cash flows. The risk may involve misclassification of the cash flows and putting them in the wrong category. So misclassification of these cash flows and putting these cash flows in the wrong category. That's the risk that can be associated with I7. I'm just touching on some of the key areas. Note that there can be other issues as well. Then from IAS 7, we have IAS 8. Changes in accounting policy and accounting estimates. So if you're reading a case and there's a change in accounting policy or change in accounting estimate, this should give you a worry because there can be a risk in that area. So if the company was using the spread line, they decided to change to another method. So once there is a change either in the policy or there is a change in an estimate, the standard says that the changes in accounting policies must be made in retrospect. But the changes, so changes in policy, you make a retrospective adjustment. I'll talk about that. So if it's a change in policy, you make a retrospective adjustment. But changes in accounting, estimates must be made prospectively. So retrospectively means that we are supposed to adjust the prior year financial statement. So if there is a change in accounting policy, so the policy, this is the rule that we are using, the rule that we are applying to our transactions. If there is a change in an accounting policy, it means that we adjust the prior year financial statements. So if there is a change in accounting policy, we make a retrospective adjustment. What happens if there is a prospective adjustment? So retrospective means we adjust the prior financial statements. Prospective adjustment means that we adjust the current year financial statements going onwards. The current year financial statements going onwards. So we adjust from the current year going onwards. That is if it's a prospective adjustment. Let's look at if you change depreciation estimate. You can estimate depreciation. You can estimate depreciation, or maybe let's say provision for bad debts. Every year we make a provision for bad debts. Provision for bad and doubtful debts. So when you make an estimate for this year, it doesn't mean you should go back to the last year estimate and adjust it. You just adjust from this year going onwards. What is the common risk here? Remember, we are in auditing, not in financial reporting. What is the common risk for auditing? The common risk in this area is that the company made a change in policy, but they did not adjust the prior year financial statement. Or the company made a change in an estimate, but they adjusted the prior financial statement. What is the risk? The risk is the change in policy being treated as a change in estimate or vice versa. The key risk is treating a change in policy. The key risk here is treating a change in policy, in accounting policy, as if it's a change in an estimate. As if it is a change in accounting estimate. We have changed the policy, but we can end up treating it as if it's a change in estimate. From IAS 8, we have IAS. So please, these are case-specific issues. So you look at the case. What were they talking about? What is it that we have in the case? You don't just say there's a risk that there should be something in the case that was talking about us making a change in policy. There must be something in the case talking about something being recorded in operating activities for you to say there's a risk that they misclassified. There must have been something about inventory being valued for you to say there's a risk that they have not properly applied IS2. You can't just start from nowhere saying that there's a risk. So it must be connected to the case. Then IAS 10, this one talks about events after the reporting period. Events after the reporting period. Events after the reporting period. So for the events after the reporting period, there are events that we say are adjusting events and non-adjusting events. Maybe let's start from what is the reporting period. So if the year is ending in December, the financial statements will be prepared as at 31 December. but they are audited, then they are handed over to the shareholders. So there can be events that are arising while the financial statements are still with the company. They are not yet handed over to the shareholders. They are still being audited. So we can recognize certain issues after we've prepared the accounts. They are still with us, but they have not yet been handed over to the shareholders. So during that period, if we recognize events that might need adjustment, those are called adjusting events. We have came across these conditions after the year has ended, but they are showing conditions that they existed when we prepared the financial statement. It's like it's an error that we realized that was made when we were preparing. So it's showing this error existed when we prepared the financial statement. So we can adjust that error. So this deals with adjusting and non-adjusting events. For detailed knowledge, you need to join, that would be for F7. So events after the reporting date. So the events are either classified as adjusting or non-adjusting events. So the events either fall into the category of adjusting events or they fall in the category of non-adjusting events. Same goes with IAS 8. The key risk here is misclassification. So you treat an adjusting event as a non-adjusting event, meaning where you were supposed to adjust, you did not adjust. So non-adjusting events with significant impact on the financial statements require disclosures. You don't adjust, but you disclose. So what are the key risks then? The key risk is failing or is treating adjusting event as a non-adjusting or vice versa. Treating an adjusting event as a non-adjusting. You treat an adjusting event as a non-adjusting event. That's number one. Or you treat an adjusting event as a non-adjusting event or failure to disclose. Hello, those online? Can you hear me now? My network is acting up. Just confirm, can you hear me and can you see my screen? Hello? Wilma? Powell?